Assalamu alaikum. Welcome to lecture 34 of SBR, IFRS 11 joint arrangements. Now, here we are going to go through what is joint arrangement. Okay, in joint arrangement there are two types. One is known as joint operation, one is joint venture. These two are different and the way you account for these two are going to be different. Okay, so it starts like this and you need to memorize this definition. Because in your exam, when a company is given to you or 2-3 companies are given to you, you should know whether they are under a joint control or not. How? By looking at the definition. So by definition, it means where two or more parties. Remember, if it's one party, it cannot have a joint control. It needs to be two or more. So two or more parties that have a joint control. That means they are controlling jointly. Okay. And another thing you must look is whether their concern, unanimous consent is required or not. Any decision requires unanimous consent of all those who are collectively controlling it. That means one person cannot take the decision. It is not based on some voting rights. Unanimous consent of all the parties who have joint control. So if these two things are there, two or more party and unanimous consent, then it's a joint arrangement. Okay, understood? Now, joint arrangements can take two forms. Number one, joint operation. Number two, joint venture. First, let us finish joint operation. Okay. Joint operation is different from joint venture. How? In joint operation, the parties have joint control. Okay. That means they have rights to the assets and the obligations for the liabilities. Okay. Remember, the reasons why I have highlighted this, the words are because these are the differences that you will find in joint venture. The ones which are in bold. Okay, here they will not be a separate entity. Joint operation means they are not a separate entity that are established to conduct joint operations, whereas in joint venture it's a separate entity. Okay, we'll go to that later. Examples of joint operation, please understand. A and B, okay, they enter into a joint operation to produce a new product. Okay, now A undertakes manufacturing, B undertakes the other. So both A and B agreed that decisions regarding the joint operations will be made unanimously. Okay, and each will bear their own expenses and take an agreed share of the sales revenue from the product. This is a joint operation. Why? Because they have the right to assets, they have obligation for liabilities, and they are not a separate entity. Now, accounting treatment. You need to remember this. Accounting treatment is very important for any standard in SBR because this is where you will be tested in your exam. If the joint operation meets the definition of a business, IFRS 3 needs to be applied. Okay. IFRS 3 we have already covered. It is business combination. Please go back to IFRS 3 in case if you want to know how IFRS 3, what does it mean and how it is applied. So same for joint operation. But only if joint operation meets the definition of a business. If it does not meet the definition of a business, IFRS 3 does not apply. IFRS 11 only will apply. But to know the rules of IFRS 3, you need to go back. Okay, I've done it. Go back and you can read this one. It's there under my playlist. SBR lecture, you will get it. Okay, now acquisition costs are expense to profit and loss as incurred. Okay, assets and liabilities are measured at fair value. The excess of the consideration over the net asset is recognized as goodwill. Okay. So assets and liabilities at fair value, acquisition costs are expensed, and goodwill is recognized. This is the accounting treatment for joint operation if it meets the definition of a business. Coming to accounting treatment. In your individual financial statement, how each reporter, joint operator will recognize? They will recognize this. Its share of assets that is held jointly. Let's say you are holding 30%, the other one is 40%. So you will recognize 30, the other one will recognize 40 in their own financial statements. Okay, its share of liabilities, its share of revenue, its share of expenses, everything its share, whether it's assets, liabilities, revenue or expenses. This is very easy. It's nothing, it's very easy. You just have to apply your percentage. You'll be given the percentage in your exam, don't worry. If it's a joint operation. Now, so all this will go, they will automatically flow to the consolidated financial statements. Okay. From the individual financial statements, from each individual financial statements, you add up together and it goes to consolidated financial statements at the end. You need to know this. Now, joint venture. This is a very interesting one. Remember the first point for joint operation? There, they have right to assets and obligation for liabilities. Here, they have right to the net asset. Here, they have right to net asset. That is the difference. Number one difference, net asset, not assets or liabilities for joint venture. Second, here a separate entity is formed. But in joint operation, no separate entity. Example of a joint venture. Same example. But here, A and B have set up a separate entity C. Okay. A owns 55% of capital C, B owns remaining 45%. They both, the decision making is in MS and all those things are there. Okay, but neither party have direct access rights to the assets nor direct obligation for the liability. Instead, they have an interest in the net asset of entity C. So you see, it's a joint venture. Now, accounting treatment for joint venture. See, in your individual financial statement, you can record it at cost in accordance with IFRS 9 or using equity method. You need to remember this very well. There is one standard that deals with joint venture. It is not IFRS 11. Which standard? IS 28. I have already finished IS 28. Go back and check how we did for associate. It's the same way. Here also we use equity method. The way we have used for associate, the equity method, same way we use for joint venture also. Joint venture only, not joint operation. If it's a joint operation, IFRS 11, this standard. If it's joint venture, IS 28, equity method. You need to know this. Okay, so in the consolidated financial statements, they'll be accounted using equity method. But in individual, remember you have choice. At cost, IFRS 9 or equity method. But if it's a consolidated, only equity method according to IS 28. Okay, it's the same. The way of creating joint venture is very similar to associate. So you need to go back to my IS 28 lecture and see how associates are treated. Okay. So now let's do questions, 2 questions before we summarize the IFRS 11. Test understanding 13, A, B, C and D. Okay, so you are required to discuss how A should be accounted for as investment in D in the consolidated financial statements. Always check whether it's consolidated or individual financial statements. The requirement is asking you. Okay, very important. Why? It differs. Okay. Here, A, B and C establish a new entity which is D. But we only want to know from the point of A. Okay, because that's what the requirement asks. A has 50%, B has 30%, C has 20%. Okay. The contractual arrangement between A, B and C specifies that at least 75% of the voting rights are required to make decisions about the activities of entity D. Okay. So now, tell me how this will be accounted for. See, look at A. A only has 50%, but to make any decision, you at least need 75%. So A alone does not have any control. Why? Because it needs the support of B also. Because 50 plus 30 makes 80%, which is above 75%. Okay. So to make any agreement, A needs B. Okay, A needs the agreement of B to make decisions. So, because A does not have control, what does it imply? That A and B have joint control. You see? This is what even in the exam you need to prove. First, you need to see whether a person has a control or not. Why am I asking control? Because if it has a control, joint control does not apply. Only one person has the control. Then it's a subsidiary. That's why. First, you have to check this number 1. If it fails here, then comes joint control. If you need 2 or more person, then it's a joint control. You see? That's why you first need to check whether it's a subsidiary or not. To be a subsidiary, only one person should have the control. But here, it's not so. So it's a joint control. Okay? because any decision to be made needs the permission of A and B together. Even if you have A and C, no, because A is 50, C is 20, it makes 70% only. It does not go with 75. So only A and B. If you put B and C, 30 and 20 is 50% only. So you need A and B to make any decision. It needs to cross that 75% boundary. So only A and B's combination will do it. Okay. So now, in the consolidated, how do you treat it? Tell me. Now you know it's a joint control. It has two things. We know joint operation, JO, or joint venture, JV. Tell me it's a joint operation or joint venture. It's a joint venture. Why? Tell me why. Look at the facts. Facts are in front of you. Tell me why it's a joint venture. Because it's a separate entity. They have a separate entity, D. They've established a new entity to have joint control over there. That's why it's a joint venture. Separate entity. This is the reason. To have joint control, they have a joint control over a separate entity. That is D. That's why it's a joint venture. And how will joint venture be accounted for? This is inconsolidated. Only one method is allowed. That is equity method. Equity method. It's a joint venture. So equity method according to which standard? IS 28. IS 28 deals with two things. Investment in associates and investment in joint venture. Okay. Now let us go to the next and the last question. This is joint operation. Already they have given you. Okay. I mean from the title you can make it out. So here you are required. You have to show how they will account for the joint operation. So this is basically more like calculation for you. So Blast has 30%. Okay. All assets, liabilities, revenue, cost are apportioned based on the shareholding. Okay. Manufacturing facility cost 30 million to construct and was completed on this date. Is to be dismantled at the end of its estimated useful life of 10 years. The present value of dismantled is given as 3 million and discount rate is 8%. Okay. Now they have given the cost. Production cost 36, sold for 50. Operating cost 1 million. Admin cost 2 million. Okay. Now they have accounted. Blast has already accounted for its share of the cost of manufacturing facility amounting to 9 million. This is for Blast. Okay. The revenue and the cost are receivable and payable by the two other joint operation partners who will settle account. Okay. So now you have been given all the figure. Now see how joint operations are accounted for. We have seen for joint venture, equity method, but what about joint operation? Now we'll show you that. Okay. So here first we'll start with profit or loss. You start with sales. Then we have cost of sales. Then we have operating cost. First I will label all and then I'll put the figure. Then we have, remember depreciation is there for dismantle cost and all. You have been given useful life and all. That is to find depreciation. Admin expenses are there. Then we have, okay, I will put it later. Okay. So remember, what is the percentage? Only 30% you have to take of all revenue and cost for Blast. So revenue is how much? Revenue has been given here as 50 million. So you're going to take 30% of that 50. Because for Blast is 30%. Which will be 15 million. Okay. In dollar million you are going to write. So 15 million. 50. Cost of sales here. Production cost 36. This is cost of sales. 36 into 30%. Everything is into 30%. This is 10.8 million. Okay, you need to deduct. Then comes your operating cost. Operating cost is how much? It is 1 million into 30%. 0.3. Now let's come to depreciation. Okay. See, to find depreciation, you have to find the amount of the asset, non-current asset. So non-current asset in this case is the manufacturing facility. Okay. It costs 30. and dismantling cost 3. This is the present value. So you have to add both the dismantling with the manufacturing cost. Okay. So here it will be 30 plus the dismantling cost 3. Take this over 10. Why? Because 10 years. Depreciation is for useful life is 10 years. Or you can just multiply 1 over 10. It's the same thing. And take 30% of this only, which will be 0.99. Again, bracket because you have to deduct. Admin expenses is 2 million. So 2 into 30%, which is 0.6. Next, remember, you have something here as you have to unwound the discount. You have been given the discount rate with this one. Now it's known as unwounding the discount. When you unwound the discount, it is what you have to write here is finance cost. It goes as a finance cost. How much? It was how much is the dismantling cost here? 3 million. And 8% is the discount rate. So 3 into 8% into 30%. Now don't ask me why is 3 into 8%. It is always like that. Unwounding the discount means is like this. You take the present value and multiply it with the interest rate, discount rate that is given. And that becomes your finance cost. Always. Whenever unwounding discount is there. So it is 0.072. You deduct. And then you get your share of net profit, which is 2.238. Do not rely on my figure. Please do it yourself and check. Okay. Now, this is net profit. Share of their net profit. Now let us go to the statement of financial position. How it will look here. So you will have a property, plant and equipment. Okay. How much? They have given you. That is share of the cost of manufacturing facility is 9 million. Okay. So that 9 million you have to take. It's 9. I'm right here. Next is dismantling cost. That is also capitalized. That's why you are adding here in the statement of financial position. Remember when you were finding depreciation, that 3 million was added with your PPE value. That 30 million. But out of that 30, 9 is for blast. Okay. So 3 million dismantling cost and you take 30%. Here you don't take 30% of 9. Why? Because they have already told here its share. Its share of the cost of manufacturing facility is 9. They have already given you the amount. But here 3 million to 30, 0.9. Then the last is depreciation. Remember depreciation you have to deduct in your statement of financial position. So already we have got the depreciation somewhere here 0.99. So here 0.99 and you get 8.910. Now next, remember they told the revenue and the cost are receivable and payable. So you have to write trade receivable. That means the share of revenue due. See how much is the sale. Sale is 15. Okay, so receivable will be 15. The revenue and the cost, the revenue are receivable, cost are payable. So that revenue is 15 million. Already they have given. That is trade receivable. Now, non-current liabilities. NCL. Okay, I'm using short form. Here, dismantling provision. Remember, dismantling provision and all is more than 1 year, so it comes under non-current liabilities. How much? Dismantling provision was 3 million, already given, the present value. Take 30% of it and add the finance cost. How much was the finance cost? It's like you are adding interest on a loan with the principal amount. It's the same like this. That's why this finance cost 0.072 you are adding here. 0.072. Then it becomes 0.972. Now current liabilities CL. You have trade payables, okay, or payables. We are taking payables. Okay, what are you doing? See, here they told revenue and the cost are payable. So what are the cost? You need to go in your profit and loss and check your cost. Already you have got. Okay, so one is cost of sales 10.8 you are going to take. Then next is operating cost 0.3 you are going to take. Depreciation already you have taken for your non-current assets, so you don't take again. Finance cost also you don't take again, it's already taken in long-term liability. What is left is admin 0.6. So only three cost goes: cost of sales, operating, and admin expense. Add here 10.8 plus 0.3 plus 0.6. It gives you 11.7. Okay. So that's it. Let's summarize IFRS 11. So in summary, we started with joint arrangement. That means two or more parties having joint control. Require unanimous consent. Then joint operation. Okay, one of the joint arrangement is joint operation, having rights to assets and liabilities for obligation for liabilities, not a separate entity. And if it meets the definition, if the joint operation meets the definition of business, use IFRS 3. Coming to joint venture, the second type of joint arrangement, only rights to net assets. It's a separate entity, and IS 28 is applied. That means equity method. So that's it. This is very simple, very short, and easy to understand as well as easy to do because less questions are there. So please go to your revision kit, pick up questions on joint ventures specifically and start doing it and see how you feel about it. Because this is an area which is not very frequently tested like your subsidiary or associate. But if it's asked, it could be asked as a group accounting question also in your question number 1 for 30 marks. So be very careful. Okay, now the next standard is again a very short standard. It has no questions. It is IFRS 12. Okay, disclosure in other entities. So see you in the next lecture. Thank you for watching and don't forget to subscribe to my channel if you haven't subscribed yet. Take care.